Studying history reveals that depressions are primarily debt and liquidity crises that are addressed in one way or another by easing monetary policy, which varies throughout time. I classified monetary policies into three categories. One is the monetary policy of interest rates. Two, investment in financial assets. It is the printing of money and purchasing of financial assets with it. 3. The printing of a large number of financial assets by the central bank, which we are currently in. Then, to finance the deficit, buying government bonds to transfer money into the pockets of those who wouldn't have received it otherwise, effectively through that coordination throughout history. Looking back to the 1800s and so on. As a result, the alleviation will take place in terms of that kind of comfort. So, when we believe that interest rates will fall to zero and that, as a result, depressions would endure, we are mistaken. Because there will be printing of money in some way or another, as we can see here today. Money's current value may not last, or it may decline. However, they will always ease in the end. That kind of reflation movement and shift will occur then. So, a zero interest rate is not the same as a ceiling on central bank's ability to relax. Manifestation in three things is needed for it to occur. Welcome to Critique, a channel that gives critical evaluation or analysis, especially in dealing with crypto. Everything regarding money, finance, investing, cryptocurrency, and blockchain-related topics including ICOs, NFTs, and yield farming. If you look back through history, you'll notice that it's happened before in the same way. It lends itself to three different types of assets responding to it. It was on March 5, 1933, when it happened. Roosevelt makes the declaration that the dollar will be separated from gold, depreciated, and reflated. Its purpose is to provide the banks with the funds they require to pay their depositors. On August 15, 1971, Nixon went on television and announced that he was ending his relationship with gold and would begin printing money. So, in November 2012, the same thing happened, with Mario Draghi taking similar actions. The exact thing occurred on April 9th when the U.S. Federal Reserve and the U.S. Congress and Treasury made their moves. In 2008, when the Treasury put up an administration and Congress put together the TARP program, similar movements occurred. They turned to quantitative easing. These are the things you constantly see unfolding, even though I haven't addressed them. That is what transpires at the equivalent of zero interest rates when they occur. Okay, we're witnessing that kind of development and that kind of easing. As a result, the easing continues. The debt and liquidity crunch are both addressed. However, it is addressed through the printing of money. That might appear in either real interest rates falling, as in the case of low inflation, or zero interest rates climbing, as in the event of high inflation. This happens eventually, even if it doesn't always happen right away, or there's depreciation in respect to other assets. So, what you're witnessing right now is reflation manifesting itself in money being bought by the Federal Reserve and the government, rather than moving into equities assets, credit assets, and so forth. And it is the embodiment which you can see in gold or depreciation. It is impossible to predict when anything will occur. As a result, when that happened in 1971, actual stock prices plummeted as inflation escalated. However, you do understand that the combo of reflation assets will occur in a manner comparable to interest rates being slashed when they reach zero. In this atmosphere, I believe most investors will assume cash is safe, and this is tragic. As a result, it is clear that one must think outside of the box. Cash is a dangerous investment. if one believes it is not a safe investment. Stocks and bonds are no longer the same as they once were. Instead of focusing on equity returns, one should consider the concept of wealth storage. All of these things that I'm mentioning must be balanced in a different way. These are not generally considered. They haven't been part of the typical investing experience for many years. To comprehend the lessons of history and even what is more likely to happen in the future, one must look back to similar periods in history and study them. And when we analyze that, we discover that over the last 500 years, you never know if you'll witness a depreciation of the value of money or a loss of wealth. As a result, your definition of risk changes all of a sudden. You used to believe that cash was a risk-free investment. Cash is the riskiest asset since it depreciates in value. After that, you begin to consider various asset classes and regions. That's exactly what we're doing. This occurs when we consider what constitutes a diversified portfolio for an easing. That's a reflationary portfolio, if you will. And how do you evaluate it in relation to other factors? Because I believe the one thing we can be certain of is that the Federal Reserve and other central banks will not allow an implosion to occur without printing a large amount of money. We are aware of the current state of interest rates. You already understand what your return will be on a 10-year bond if you buy one. Then you figure out what the predicted returns of other asset classes are. Begin by looking at the interest rates of each of the companies that are borrowing money, and then move on to the next step. In terms of their predicted equity return versus their interest rate, depending on the discounted cash flow's present value, all asset types, including private equity, venture capital, and others have extremely low projected returns. That is, if you merely hold them for the next 10 years, you may not be able to make a profit. They'll all be underwhelming in terms of return and will be priced accordingly. As a result, that is a fact of life. We all know that monetary policy has an impact on asset classes. As a result, when they decreased interest rates and did a variety of other things in the past, asset prices rose. We know that some of those things will not be possible in the future. So, if we start taking the idea of it, we'll see that you can go to possibly negative returns. And it's all occurring because it's necessary from an economic standpoint. It is necessary since there is a great deal of debt and liabilities. Pension liabilities, healthcare liabilities, insurance company liabilities, and other unfunded liabilities are all coming our way. As a result, they require greater returns. As a result, we've been in a situation where those returns have been leveraged up. Because the central bank has injected all of that money. Because it was necessary to be redistributive in the absence of interest rates. We have all of that cash digging into all the nooks and crannies of all asset classes in order to drive up their values relative to predicted returns. As a result, their predicted returns will be small. So that's the situation. We know there will be volatility in the aftermath of it. You have volatility as a result of the events we've witnessed. Some of these things are relevant if the virus causes a drop in the economy. There is a lot of mystery about the virus. It has monetary ramifications. Then you have a whole new universe of monetary policy to deal with. That new world of monetary policy means that capital allocation will no longer be done in the methods that we were used to in the past. Though it is possible, this capitalist economy would rely on central banks to deposit cash. Then, bankers would consider borrowing that money and lending it to institutions or persons who would repay it, and on which they will make a profit. Today's free market has made the allocation of those funds far less. Central bankers and governments are now the ones who decide whether or not to infuse money into the markets. As a result, the manner in which they do so and the emotions that result are causing and will continue to cause volatility. It's quite similar to the war years, but the capital allocation and how it's functioning will cause volatility. We're seeing some volatility. As a result, you must cope with that volatility. However, that is the environment's character. That's what makes the environment a reality, right? Is there anyone who disagrees that asset classes' returns will be low just in terms of expected returns? And that monetary policy, which today consists of buying financial assets and printing money, will be a lever that has an impact on that. As a result, we'll see volatility and a high level of uncertainty in that environment. As a result, there are ramifications. Isn't that the truth of life if we agree on it? Is it possible to agree on that? I think we'll see poor returns, insufficient returns in general in relation to demands, and a lot of volatility around them. Can we all agree that this is a reality? I believe it is. Then there's the matter of how to tackle it from an investment standpoint. Let me explain it this way. It is more crucial than ever to achieve balance, which requires diversification. However, the return will be lower than before. So, do you seek a return on an asset class? Or do you prefer a well-balanced asset portfolio? So, for example, will you select a 60-40 stock bond mix, or if you take equities, or if you take any of those things? I'm suggesting no. I believe the most important thing is to begin with a well-diversified portfolio. Asset class diversity, country diversification, and currency diversification are all important. Because I believe the one thing we all realize is that we don't know very much. Isn't it difficult to predict what will happen at any given time? As a result, we should be taught humility. It's not like one product is definitely better than the other since markets are relatively efficient at making those comparisons. As much as we know, certain things are greater diversifiers than others in terms of generating whatever surplus return is desired. That it is as stable and risk-free as possible in order to achieve balance. So, looking ahead, we may predict that excess returns will be lower. The premiums were less expensive. However, having a well-diversified portfolio is still preferable. Although the excess return will be lesser, it will still be more stable. Because the different components will all have modest returns. However, when they are combined, it will become more stable. The concentration of any individual asset class in any country, in any situation, has historically been harmful, and it is still dangerous today. Short break. So, if you think this video has clarified some things for you, please consider liking it and clicking that bell button to be notified of our new videos. Also, you might want to consider subscribing to our channel. It'll really help us out. Back to our video. So, what we're seeing when I glance at it, for example, is reflation. Central banks are printing money and purchasing assets. They're doing it now, and I believe they'll keep doing it. The question then becomes, does this materialize in a way that drives stock values higher? Does it cause the worth of money to fall and the price of gold to rise? So, in the previous year and a half, I've gone back in time to the beginning of time. You're familiar with the 500-year study of all these specific examples, and you're aware of the exact set of possibilities and all of that range of options. You will receive clarity. However, the teachings of what would happen were largely in place before 1945 when we started our monetary system. What I imply is that we've been living in an ideal environment since 1945 when the new monetary system and the dollar-based monetary system were established, and we've been living in it ever since this reformation. And it's been a fantastic environment. We've picked up some habits from that setting. Real returns are important for most investors, but not all investors must consider them, since they've established a fixed liability in some circumstances. In any event, I believe the most important factor is that nearly no investor has enough money to meet their needs. It may have an impact on the time horizon. However, if you looked at the wealthiest investors in general and looked at their income, expenses, and savings, every individual, corporation, and country would have to go through the same effort. Can you pay on your liabilities or send out that amount of money based on the income you're getting, or the manner you'll have to dip into your savings pool? You can see individuals who will not be able to make it all around you. It's possible that it won't be able to come close in the time we have. You must consider what that means. This means that those will not be defaulted. You can't inform the majority of people they won't get their money. That will necessitate the printing of a significant amount of money, because it is necessary to print that sum of money in order to cover those liabilities. So that is the predicament in which we and most of the globe find ourselves. When I contemplate investing, I want to put my money into countries that are competitive. I'd like to invest in several countries. I'd like to make a multi-asset investment. I'm looking for a multi-currency investment. I also want to keep wealth in my possession, because money is not destroyed as much as it is created. It's transferred from one asset class to the next. There is asset class competition, country competition, currency competition, and so on. They travel around a lot, so they have to diversify early on. Then they proceed to the location of the alpha sources. How does one go about putting together a well-balanced combination of alpha sources? As a result, it's the same, a well-worn tale. And with that, this concludes our video. Acquired a lot of knowledge from this? We recommend checking out our other relevant videos from our channel. Also consider sharing this video to any friends or family members who might find it useful. Until next time!